And then we'll do this one right here. So we had an intended start time on this for 1 o'clock. So I'm gonna just give it 2 or 3 more minutes since they just came off the other call. Looks like we might have a couple people showing up here yet. So just hang in there for a minute or two and we'll get started.
Sounds good.
How are you? I'm good too. If you have access to the Zoom presentation, or I'm going to have it up on the screen here. I didn't print out any of the slides because it's just 3 slides. So, but I can give you the slides after the presentation. And Rob, I'll email you the slides after the presentation also, so that you have them and for your reference. I'm not sure if they're recording this or not for later. So if no one else decides to attend and it's just the 2 of you, we'll make the best of this time together. But at least we got more than 1 person. We got 2, so that's good. Yeah, this is this is kind of like one of those things where in the midst of everything that you're trying to learn while you're going through the transition of getting acclimated, there are a lot of different things that the lender has to have involvement with that you can feel really confident about, or you can feel like a sense of uncertainty if it's not managed properly. And so my goal is to try and simplify that as much as I can. So I'm going to give it just going to give it 1 more minute here, and then we're just going to jump right into it. Hey, take your mask off. We're practicing social distancing. All right, so out of respect for your time and the fact that both of you showed up on time, and we should probably just get started because it's, if anyone else is gonna hop on, they can just be late to the party. So for those of you, for the 2 of you, just to kind of get a little background, I'm from Bank 59, which is out of Oconomowoc. We're a community bank. I've been working in lending since the year 2000. And Rob, I'm looking up from the camera a little bit, just out of respect for, engaging everyone. So basically my goal is to provide you with some insight on some things that'll come up along the way while you're going through the transition of understanding things that happen when you're getting acclimated to your, different things that are going to come up while you're getting going. So one of the things that Kathy Whitaker talked about, one of the things that Kathy Whitaker talked about while she was on the sales meeting call today was the fact that we are really trying to be a partner to you. We are really trying to make sure that we impress upon you that we're available. And, when you think about availability, you have to think about some of the things that affect why the lender needs to be around. And whoever that lender is. So your customer can say that they're going to want to work with someone, and that person is either the one they want to use because of where they bank. Maybe it's because their family told them they should go to this person or this bank or this credit union or this mortgage company. But ultimately, in the day and age that we're in, we experience a great deal of lenders who are suffering from capacity issues. Capacity issues occur in the summer months when there's a lot of purchase activity going on, people buying homes, but it also occurs when interest rates are historically low like they are right now. Does anyone know what the interest rate is for a 30-year fix today? Roughly, ballpark? Yeah, 2.75 to 2.875. That's the going 30-year fixed right now. And in all the years that I've been doing mortgage lending, I can tell you that just up until like May was the first time that I actually saw an interest rate below 3.25% for a 30-year fixed. So going back 20 years of doing this, it's literally the first time I ever saw an interest rate that low. When the interest rate dropped below 3%, we basically just had to adapt to that being the next new normal. So it's a pretty interesting time to be in the industry. I'll look back on this time for sure and not forget 2020 for not just for the reasons you would think about, but also because like what the rates are doing. So updated pre-approvals. So if there's one thing I would make a note of as a part of your, what I'm sharing with you here, it's that pre-approvals are good for 120 days. So if a lender does a pre-approval, what is the reason that that pre-approval expires? And the number one reason is because the credit report expires. So if a credit report expires, what that basically means is that the lender has to update that credit report, and they have to make sure that the customer's credit scores and their liabilities on their credit report are not going to affect their ability to be approved. So if you get a pre-approval letter, let's say you've got a listing and the pre-approval letter says either a different address, it doesn't have the address for the property, or let's say the date on the pre-approval letter is really old, it would be an opportunity to call that lender up and ask them, hey, is this something you can update for us just to make sure that everything looks good? The next thing about availability is scenario questions. So we have various cases where someone is writing an offer and it's a Friday night after 5 o'clock when you might be going to a fish fry or you might be doing something outside of work. And the lender might not be immediately available to answer that question, but if there's a loyalty because we're helping you, we're your teammate, your partner in business, we're going to be making sure that you understand that we're around for that call. And if you don't get us right away, if you send me or Amy Canada a text message, we would aspire to be getting back to you within 1 hour. Okay, so going back to the first slide, Amy Canada, who is on this presentation, she is my business partner in our department. And if you need either one of us, you can always reach out to Amy Canada as well. And again, I'm going to send an email out with the slides for everyone. But scenario questions can really run the gamut. Is there a property condition issue? Is there so let's say you might have a foundation issue or a roof issue or something else that you're afraid might affect the ability to close on the transaction. Maybe it's a unique property. Maybe there's something going on with the fact that it's going to be an FHA property, and we'll talk about FHA loans in a little while. Maybe is there a chance that the property might not pass a property inspection, and there's going to need to be something that has to get addressed. But anyway, scenario questions can really be a very broad thing. Endorsing the buyer with listing agent. So this is one of the biggest things that Kathy and I aspire to in the way that I serve her clients, and a few of the other agents use me for the same purpose. So as a lender in this area, a good majority of the really experienced mortgage lenders have had a chance to cross paths with a lot of real estate agents over the years. And I'd like to think that I'm one of those lenders. And so I have a style about the way I present and the way that I share with the updates and things. I'll do an email, a text, or a phone call, depending on what the rapport is with the listing agent. And I will make sure that I will edify the buyer. I will talk positively about the buyer. I will talk positively about the buyer's agent. I will make sure that I'm endorsing the fact that this buyer has the ability to proceed with confidence to purchase that property. Maybe they're in a situation where they're in competition and they had to remove their home sale contingency to buy a home. I want to make sure that I point out their strengths to get them where they're trying to be. So the availability part really is like an intangible. It's like if you didn't experience something where the lender was radio silent or stuck their head in the sand, whenever the time might be, you won't really realize how important that is until you run into the situation. Product knowledge. So when we talk about product knowledge, which we can have future discussions about this. Right now, I'm trying to do like a high level discussion for everybody about product knowledge. it's basically down to the fact that there's 3 families for mortgages, 3 families. So the first family is going to be what you would normally think of. That's the conventional mortgages. Conventional would be your traditional loans through Fannie Mae and Freddie Mac. So Fannie Mae and Freddie Mac are government secured entities that basically allow us to make fixed rate mortgages for loans up to $510,400. And I would write that down if you're new to the lending aspect where you're not totally familiar. I would want you to know the difference between a conventional mortgage and a jumbo mortgage. A conventional mortgage is loans at or below $510,400. The guidelines for the jumbo mortgages are different than they are for conventional, and jumbo are going to be 2 different types of requirements depending on the lender and depending on whether or not it's a fixed rate or an ARM. Typically, you'll find on the jumbo loans that you have extra reserve requirements, and it's more strict for how you qualify for those kind of loans. Another one of the families is going to be the government loans. Okay, a government loan is going to be when you have an FHA mortgage, a VA mortgage, or a USDA mortgage. And I always joke around, but I'm kind of aging myself a little bit when I say this. I just turned 46 last Friday. Has anyone, do you ever remember the old commercial, "Where's the beef"? Yeah, so USDA. So I always jokingly think about USDA financing as "where's the beef." So USDA financing from US Department of Agriculture, that's going to be a rural housing loan. That's going to be the loan that's 100% financing. And it has income limits. And it has a lot of similar restrictions that you would find with FHA or VA. So an example would be that you have property condition requirements, like you can't have chipping or peeling paint. You can't have a safety hazard like exposed wires, or maybe there's the shingles are curling up on the roof, or maybe the garage door doesn't open and it's considered a safety hazard, or maybe there's a hand railing missing going up the stairs and the appraiser has to mark that down because that could be considered a safety hazard. I'm not going to go into great depth on other types of property condition issues at the moment because I'm really trying to get through this whole outline, because the 60 minutes is going to go by really fast. We're already a quarter of the way through. So, but just understand with the families, VA, FHA, and USDA, those government loans, the USDA and the VA are 100% financing. USDA has income limits, and it also has restrictions on where you can purchase a home. So that 100% financing is going to be available to USDA or VA, but if you're going to do USDA, you have to go to their website and type in the property address and see if the property is in an eligible area. Okay, so we have some customers that we serve where we would really like to be able to provide them with 100% financing. And the only way we can be sure that we can do that is by checking the USDA website. For example, there are no USDA eligible properties in Milwaukee County, okay? You'd be really surprised areas that are eligible for USDA that you might not think are eligible for USDA. For example, Delafield. There's areas that I would consider fairly urban areas that are eligible for USDA financing that you wouldn't think would be eligible. So when you go to that map, you can type in an address and you can test it out, and you'll see that there's shaded areas. And I would search for USDA property eligibility in Google to find the link. That will be the easiest way for you to find that link. Also, I talked about 100% financing, and did you know that there is an option for 100% financing with FHA? And that option is going to be through an entity that's called WHEDA, W-H-E-D-A, WHEDA. WHEDA stands for Wisconsin Housing Economic Development Authority, and WHEDA's been around for a very long time. The way that they do the 100% financing is they'll do a first mortgage for 96.5% of the sales price, and then they'll do a second mortgage for 3.5% of the sales price. That's how you get that 100% financing, because FHA wants you to have one loan not exceeding 96.5%. So the way that you do it with the zero down is to separate and do that second mortgage that WIDA will provide. And they provide that loan for customers, whether you're a first-time buyer or not, down to a 640 credit score. I'll talk more about credit scores a little later. There are some options that go below a 640 credit score, but again, I'm going to stick to high-level discussion here because I really want to concentrate on giving you guys a lot of the basic information, and maybe that'll open a thought or a trigger, an idea that's something you want to maybe ask a question about. We'll get to questions right at the end. So write down your questions if you have something you want to bring up. If you all have it's good to have a little healthy dialogue here right at the end for questions, because we might be able to share with each other and have some other takeaways. So, so the VA option, I had talked about VA, and that's going to be someone that has established enough time in their years of service in the military that's going to be eligible for 100% financing. If they're going to use what's called their entitlement. So if you talk to a veteran or someone who's in service, I always say this: you want to thank them for serving, just really just a respectful thing to do, especially in today's day and age. But then also ask them, and regarding your entitlement, you would basically want to ask them if they had ever used their entitlement before. The privilege of getting VA financing is known as your entitlement. Okay? So with a VA loan, if you have an unmarried spouse, like a significant other, you cannot do 100% financing with I call them a co-borrower. You might call them a co-buyer. I call them co-borrower. You can't do 100% financing with a co-borrower unless they're married. If they are unmarried, it will require the customer to put a sizable down payment down because the VA won't provide the same level of insurance. The next thing I would touch on is, as far as like loan options go, we talked about conventional, we talked about government. There's one more that's really important. And, while you're getting acquainted, I want to reinforce here that you can always contact me, and Rob already has. Thanks for doing that, Rob. You can contact me whenever you want at the phone number on the card. Send me a text, whatever it is. I'll try to answer you as fast as I can. There's another product that's really important to mention, and that's going to be a portfolio loan. So with portfolio loans, you're going to find that there are a couple of lenders in the area that can do a portfolio loan, but the majority of them won't. And the reason why is because they're using their bank's assets or their credit union's assets to make that loan. And it's going to be a requirement to use portfolio loans for a bridge loan. And we'll talk about bridge loans a little later. It's going to be a requirement when you have a scenario that doesn't fit the typical credit box, or the scenarios that you'll see with like Fannie Mae and Freddie Mac. They have a really common denominator, and that common denominator is, and I would write this down, you cannot exceed 50% of your gross monthly income when you add up all of your monthly payments on your credit report, including a mortgage. So take a family that maybe combined makes, let's just say $8,000 a month. And we have to make sure, we have an obligation to make sure that their monthly payments, including their current mortgage, if they have one, does not exceed $4,000. If it does, they would need to get a portfolio mortgage instead of a traditional mortgage, because that's the only way that they would get approved for their financing. If I fell in a situation where I exceeded that 50% loan to value, that lender is going to want to know, does that customer have an exit strategy? Do they have a solution that's going to allow them to pay off that portfolio mortgage eventually and replace it with a traditional mortgage? Because after all, if I'm borrowing the money to someone, I don't want that loan to be sitting on the shelf for 15 years. I'm just trying to help you get into this property that you might not otherwise be able to get into. I'm going to stand up for a second, see if I can move. You guys can, there we go. All right. So yeah, again, with the portfolio thing, those come into play in a scenario. I'll just give you a couple of fast examples about portfolio loans. The portfolio example comes into play when you have, let's say you have a property that has too many property condition issues. Let's say it has a bad septic, a bad roof. Let's say the property is not eligible for conventional financing. let's say that the buyer is going through a divorce and there's something about their situation that is going to eventually get better. It's just not better right now. So you might find that a lender turned them down and they still want to do something and you still want to serve them. And let's face it, we still want to be able to look at the end of the year and say, how many leads did we get versus how many closings we had, okay? Closing to leads to closing ratio, I like to, as a lender, I like to call that my capture rate. So if I had a scenario where I got, I had so many leads, I went to so many closings, I want to try and manage that so I know what my effectiveness is for the time, for what I'm doing. And I can talk to you more about my vision for all of that stuff some other time. I love talking about goal setting, and I know you're going to get flooded with goal setting in the Keller Williams curriculum, but I love talking about that stuff. So talking about, I think we kind of really elaborated on product knowledge and the loan programs like the families. Let's talk about discussion on appraisal matters next. So if you had a scenario where you had a low appraisal on a property. Now, when a buyer goes to purchase a house, let's go high level again for a second. Let's talk about the basics of the appraisal and what it means. The appraisal is there to do three things. It's there to make sure that the value is supported in relation to what the buyer is going to finance. It's there to make sure that there's no property condition issues that would affect the lender from their ability to, if they had to take the property back and resell it to get back what they put into it for a loan, that they're going to be good there. And then the last item that you might have that comes up is an evaluation if the property is a rental property or if it's a condominium. And if it's a rental property or a condominium, the appraiser is obligated to point out certain things about the fact that it's a rental, like what are acceptable rents in the area. They might have to demonstrate that the rental market supports the type of rents that the buyer is saying they're going to get from this property. So they'll do something that we call a rental analysis. And that rental analysis will talk about reasonable market rents in the area. So that appraiser will survey the MLS, and they'll maybe survey Craigslist and a few other places to see what reasonable rents are in the area where that property is located. If it's a condominium, they might do some other things. They might look at like how much of the project is being used for commercial versus residential. And they also might look at certain other attributes regarding the condo association, like are the common areas complete in the condo association? That's also really important stuff. Because if the common areas are not complete in the condo association, that would, like, so maybe you have like a clubhouse, or maybe you have a bunch of landscaping, or there's a common shared space in the condo association, that would mean that that property is not eligible to be closed on conventional financing. So the appraiser has to mark that down too. Now, and let's say you have a bad appraisal. So now we're going to just do, I keep saying this, high level, because I could sit here, I could spend an hour talking about appraisals. With appraisals, here's one of the biggest things that'll happen. You have a scenario where your buyer is in competition and you're going to write an offer over asking just to get that buyer into the property. The only problem is the buyer only has 5% out on the house. So what happens, here's going to be my first quiz question that's almost kind of a little obvious. What happens if you guys write over on an offer with a buyer and your buyer's putting 5% down and the appraisal comes in low? What happens? Rob, you want to chime in? Anyone want to give it a shot? That's a great answer. Yeah, the buyer would need to make up the difference. And the problem comes in when the buyer was putting 5% down and that's all they had to put down. So, hey, Rob, I'm just going to unmute you, or maybe you can unmute yourself in case you want to chime in because you're muted. If you want to chime in, just please do. It's okay.
Sounds good.
So I'm going to give you a really simple example. Let's just say that hypothetically speaking, we're buying a $100,000 property. We're putting 5% down. And so that's $5,000. We're going to mortgage $95,000. And that property appraises at $90,000. So now we have to make up that shortfall. So one of the things that you'll find, and Cindy Coos, who was on the sales meeting call, she added some language in the Google Docs regarding proper verbiage in an offer to purchase where a buyer will be held responsible to make up the difference in a shorted appraisal. And the reason why that's going to be really important is because if you're in competition, you can kind of like close your eyes and pray it's going to be okay, or you can face that thing head on. So facing it head on would be something like this. Buyer agrees to cover an appraisal shortfall not to exceed X amount of dollars below agreed upon price. So if it's 5,000, whatever it is, you can specify how much the buyer is willing to cover, because otherwise you're leaving this big gap. If someone else addresses that in their offer to purchase and you don't address that for your buyer, if they know they're going to have the extra money, they're going to offer extra. If it appraises low, what you're doing is you're leaving them vulnerable. And here's why you're leaving them vulnerable. This is like, I realize I'm kind of going a little bit more advanced on this, but this is like totally a thing in this market, okay? So like I'm trying to like, I'll say like, not just like, just go really so basic that you guys aren't walking out of this meeting with takeaways. I want to give you some things to make you think, challenge yourself, feel like this was worth spending your time. So if I had a scenario where I address that, what I'm basically saying is to the listing agent is I've acknowledged the fact that my buyer A has the extra money to do this. Because otherwise, if you don't address it, they don't know whether you have the money or not. And then if the appraisal comes in low and all of a sudden you think that's an opportunity, or your buyer think that's an opportunity for them just to renegotiate. And if the buyer thinks they get to renegotiate, now are we just really going back to square one? Well, I had 2 or 3 other offers that I could have accepted and I chose yours. So that kind of makes it difficult for what everyone expects. So that's why in the beginning, you need to manage that expectation with that buyer. This is a golden opportunity for them to get to a closing on this particular property that they maybe had their heart set on. And we want to make sure that we preserve that opportunity. So I realize that one for someone that's new, that is really just getting started, is really more advanced, but Cindy Coos, Kathy Whitaker, myself, I can show you guys where that verbiage is so that you can learn that piece. Because I think you're really quickly going to start getting into a spot where you might write an offer over asking with a buyer if you want to have a shot at a property. I'm sure you'd probably all agree.
Bill, I got a question on that.
Go ahead.
So how do you, I mean, you kind of told us about some verbiage as to how you write it up, but you can't just write it up without some like proof, can you?
Well, you can, so that's a really good question, Rob. So this is where we're getting into what I would call some advanced due diligence. For lack of a better way of describing it, you're doing some due diligence. You're looking at home sales in the area. You're evaluating whether or not there are any comparable sales that will support the value of that property. And the comparable sales, Rob, and I'll say this to clarify how you're going to get that information if you haven't already gone here. So aside from relying on someone in the the leadership team here, or maybe someone that you're partnering with just while you're getting, because you have a partner while you're getting going, you're going to look at recent sales that are closest to the subject property and that are the most recent sales. So recent sales would be, just like it sounds. If you go and look in MLS and you said, okay, in the last 3 months, 6 months, 12 months, there were only these couple homes that sold, and we're coming in over those. So it's quite likely that this place is not going to appraise. So you have to try and get an idea how much over it's going to be in order for you to really kind of delve into that with the buyer. Does that answer your question?
Yeah, I guess I'm just wondering, like, do you need verification from the bank that you're going to be able to cover that extra amount?
Yes. So, and you'll see this when we get into like I will pull the verbiage and I'll send it to you that was added that talks about verifying that the buyer did have the additional assets to support it, asking the lender to demonstrate in writing that the buyer did have the additional assets to support that, word for word, is absolutely a best practice. That's something that we're not going to want to be vague on. We will say it is acknowledged that the buyer will be covering any shortfall on the appraisal up to $5,000 below the sales price, and the buyer has demonstrated that they have funds to support that. And I can support that by various means. I can get money from a retirement account. I can get money from a gift from a family member, or maybe I have that money liquid in my bank account that I can use to support the situation. So, and these are all things that you're experiencing, or like I'll say, like exploring with that buyer. The buyers, I'm not going to mince words here. The buyer's going through some emotional decisions, right? They're either, maybe they're kind of scorned a little bit because they lost a property already, or maybe they already know because you called the listing agent and they told you how many showings were on the calendar for the day, or they know that they're going in competition. So you're gonna provide that due diligence. I'm gonna make a note and make it really important priority to provide you guys with that verbiage for all that stuff. So yeah, to answer your question directly, Rob, you're gonna get something from the lender, maybe an update to that pre-approval letter that acknowledges that you went in over asking. That will cover the shortfall if you do put that verbiage in the additional contingencies area of the offer to purchase. Okay.
Thank you.
Okay, so you need help, and the other lender is being evasive, not taking ownership for the situation with whatever it is that's going on, or they're acting like they don't understand what you're asking them. That's when you call Amy Canada or myself. Amy's cards are right outside outside of the office door where we are. Okay, so and she'll be doing some future classes. She's just not here right now. So call us, or ask us about the appraisal situation, the appraisal questions, property condition questions. If it's a really unique property, that's going to be a reason to reach out. If you have a situation where you're going to do something that's new construction, let's say the buyer wants to go write an offer on a new construction property, Rob. And oh, by the way, hi Jenny, I can see you listening in there. Let's say the property's not complete. You're going to want to try and make sure that you know what that process is going to look like. Let's say the property's new construction and the yard isn't in, the driveway's not in, a lot of the finishes on the interior need to be done. Write this down if you're not familiar with it. That's called a turnkey property. A turnkey property is when, kind of like it sounds, you're going to buy a house that is new construction, but the builder built that home using their own funds, and they're going to turn around and finish that for the buyer with maybe some additional color selections or what have you. Maybe they're going to add in the driveway, maybe they're not. Whatever the case may be, that stuff's all going to be taken into account. So number 3, unable to know that lender's current volume, the lead time for appraisals and underwriting. So some mortgage companies in the area are in a position right now where they do not have capacity to underwrite their loans in-house. They are working with appraisers that are maybe suffering from a similar backlog because of the volume of refinance transactions that are going right now in the marketplace. With the interest rates low, all the people are basically flooding the mortgage companies and the banks and the credit unions with refinance applications. Our turn time is 3 to 4 days for an initial underwrite. Right now, we know of a few places that their turn time is over 30 days. And that's why, like, this whole idea of what I'm saying to you is not intended to scare you. It's more so intended to make sure that you're not trying to, I'll use the phrase, kind of like I remember when I was a freshman in high school, I used to remember someone that used to watch the hallways. We used to call him the hall monitor. So jokingly, I'm saying that, like, what's the person, what's the loan officer or the real estate agent looking like if they were to say, oh, well, why don't you call your current lender and see what their lead times are? You're a hall monitor then, right? But you're protecting your buyer. So if you have a turn time for an appraisal or a commitment letter and you aren't sure that that lender is going to fulfill those deadlines, or actually even realize that the deadlines exist, you're going to give them a call and you're going to say to them, hey, would you mind just letting me know what your lead time is for an appraisal or for the underwriting to be completed? Because we don't want to have those dates pass in our offer to purchase. And then suddenly we're not in contract with our dates and deadlines. I'm going to quiz you guys on one question because I'm trying to make sure that I realize I'm just like flooding you with stuff and I'm not giving you a whole lot of room to talk. So if I pass the loan commitment deadline in the offer to purchase, true or false, can the buyer back out of the deal? False. The only time the transaction can be canceled is by the seller if you pass the loan commitment deadline. The buyer is not allowed to bail on the transaction just because they miss loan commitment, but the seller can. And that's why it's really important to make sure that you don't pass those deadlines. If you know you're going to be close on the deadlines, you would get an amendment to the offer to purchase, amending the deadline for the either the financing or for the appraisal to make sure you don't pass those deadlines up. Rescue files. So let's see, we got 24 minutes left on the transaction, or on the on the get together today. I'm going to try and make sure I can get through the rest of these questions a little more. I'm going to keep things moving here, I guess I'd say. So rescue files. You found out the buyer's credit score dropped. They can't get financing through the lender they're with. That would be a rescue. A situation where something happened on a transaction, it needs to be restructured, that's a rescue. Something where you are in a spot where you got to do a fast closing, absolutely that's a rescue. Rush requests. If you're in a spot where you need to close a transaction in 30 days or less, right now that is a rush request. A rush request used to be 2 to 3 weeks. Right now a rush request is 30 days. And it has to do with the volume of applications flowing through the system at basically all the lenders. What is an overlay? Can anyone guess what an overlay is? It's kind of just like what it sounds like. And I'm not going to hold anyone's feet to the fire. I love the fact that I'm the one with my mask off, because then you guys at least know that I don't have resting bitch face. And I'm trying not to be way too serious today. That's why I just wanted to make sure I loosen up a little bit. An overlay is when a lender has a unique rule that is specific to their lending that they're requiring in order for someone to do a mortgage. That's an overlay, okay? So an example of an overlay would be, there is a bank in town that requires, let's say my wife and I are applying for a mortgage, and she had a really nasty divorce and she had a bankruptcy, and with her credit on the application, we're not going to be approved. Well, there's a bank in Brookfield that will remain nameless that requires husband and wife on the application no matter what. If you're married, you have to include your spouse on the application. That's it. You don't have a choice. So just keep in mind that if there's an overlay or you hear about anything unique, like you wondering, like, I never heard of that rule, you might ask the question, is that an overlay with your lender? Can you find that out? That would be something I would want to know. We're going to go into, we got 8 more bullet points, and we're going to break these down as fast as we can so we can get a little time for some Q&A. So what to watch for? We talked about offers over asking, outdated pre-approvals, and expired credit reports. We don't want a deal to go sideways because the customer has been looking for a home for so long that their credit report expired, and the assurance as to whether or not they're approved may or may not be acceptable. We don't know. So we talked about offers over asking, pretty good. And then minimum down payment requirements for buyers. for first-time buyers. So there are some grant programs out there. There are some low down payment options out there, 0% down, 3% down. All of those programs have income limits. So if you know someone that wants to try qualifying for one of those programs, I'm going to give you a tip. I'm going to encourage you to not make the ability to get a grant a reason to buy a house. Here's why. It's really simple. You're gonna completely resonate with what I'm about to say in 10 seconds. The buyer calls the lender and says, Bill, we're calling you because Rob said we can get a grant. And all of a sudden I look up their income and I verify their income and I find out that they make too much money. And I now say to them, sorry, you're not eligible for a grant. The income limit based on the size of your family and the city or town that you're living in is X, and you make Y. Suddenly that person may not be as excited about buying a house anymore. So you go into the situation as if the person is qualifying for a minimal down payment, a 0 to 3% down payment. And great news, Mr. Customer, while we're going through that process, we're going to have you screened to see if you're eligible for grant funds. It's all in the way you present it. Because if you make it like that's the reason for doing business, now that person establishes that expectation in their mind. As simple as that may sound, it has happened to me that people have gone sideways or run off the rails because they couldn't get a grant. There are income limits at WHEDA.com, WHEDA.com. If you go to WHEDA, you will see that the income limits are listed there so that you can go in and see what first-time buyers' income restrictions are based on their family size. So if you have kids, you have a higher income limit than if you don't have kids. If you are in a situation where you want to look at first-time buyer programs or grants, we do have a grant that's called Down Payment Plus. Down Payment Plus, if you write that down, there are a few banks in the area and I believe 2 credit unions that can offer it. Down Payment Plus allows people to get up to $6,000 in forgivable grant funds, so long as they stay in the property for at least 5 years. And if they don't stay in the property for at least that amount of time, there is a chance that they would have to repay some of that money. So grant funds are eligible to people based on their income, their property type, and also, believe it or not, their credit score. So if you have a credit score below 640, you will not be eligible for a grant with the majority of the grant providers that are out there. So the next thing is, when can a buyer receive a gift and who is an eligible gift donor? So I have a client buying a house. They got a divorce. They now have a girlfriend or a boyfriend, and the boyfriend wants to give money towards the new home purchase. Can they do that? You should know I'm asking you guys trick questions, right? You can't do that. You have to be a fiance. You have to demonstrate either by like a Facebook announcement or an engagement announcement of some sort. You have to provide some type of reasonable proof that the person is engaged to be married to the person who is giving the gift. Another good one. I am getting a gift from my fiance's father. Is the fiance's father an eligible gift donor? If I just said you can get money from the fiance, is the fiance's father an eligible gift donor? And the fiance is not on the purchase. You cannot do that either. You have to be married in order for you to get a gift from, it would need to be a father-in-law. That is considered an eligible gift donor, but not a fiance's father. That's another example where the lender has to know the rules, where if you don't know those things, something like that's going to go sideways pretty quick. And if a buyer is receiving a gift, how do you document the gift? So if we had a scenario, and you guys will run into this one. So let's talk about wedding gifts. for a second. This is one of the most popular ones that comes up, okay? Because you know what I always talk about? You always have to think about triggers. So think about triggers when you think about like who is a candidate, like if you're hunting for buyers or sellers, who is the most likely candidate to be buying a home or selling a home? And through a lot of the things that are going on with technology nowadays, we think about something that I like to call artificial intelligence, or the things that you associate with someone that's most likely to make a purchase. This is something that's really studied if you actually look it up. So diamonds, diapers, and divorces, okay? This is like not a revelation if you really think about it, but these are cases where you're most likely to do a real estate transaction, right? So if you were in a position where, if you had a scenario where someone is going to be getting married and they're going to get a ton of wedding gifts from family, and I got all these checks, I got a bunch of cash, okay? We have to paper trail money towards a purchase, okay? So basically what would need to happen is we would need to be able to, the underwriter has to use enough discretion to be able to discern that those deposits occurred in a reasonable amount of time within when the wedding happened, okay? So if the money was way before the wedding or way after the wedding and you deposited all these funds in this amount of time, but all of a sudden you had this really large deposit a month and a half later, you'd have to exercise judgment to make sure that you source the money. Because if you don't source the money, it's what we like to call mattress money. Mattress money is exactly what it sounds like. I don't know where it came from. So the best practice here is to get copies of checks if you can. If you can't, you're going to get the wedding announcement. You're going to make sure you document that money the best you could. But the wedding gifts are one where if I know someone, like, yeah, we're going to shop for a house and we're not going to go buy one until like 2 weeks after we get married. Okay, well, here's what you're going to want to do. You're probably going to be getting some wedding gifts. Let's make sure that you handle that properly. Now, the lender, of course, will probably tell them that. But if you can head that off before it becomes a problem, it's a great idea. You'll be happier that you did. So I talked about rush closings and what if you don't know the lender. You know, I will send a text message. If I were you, send a text message to that lender. Hey, I'm working with your buyer, Mary and Jim Smith, and they're really looking to write an offer at 1234 Main Street. We're going into competition. Can you please give us a rough idea how fast you can turn around a closing? It sounds like we might be up against some people that are trying to close in 25 days, and see what their response is. Managing repairs with the lender and how the offer to purchase can affect the outcome. So this one, we could do another hour on it, but we don't obviously have that amount of time. And we could talk about this stuff later on too in a future class. If you were in a situation where you had a scenario where, let's say that the seller was given the right to cure, okay? And let's say that the seller has the final say on how a defect gets corrected. So in this example, let's use grading and downspouts, okay? We had a basement inspection on the house. We did a drain tile test on the house, and we made sure that the property passed the drain tile test. There was no issues with the foundation walls, but the basement inspector did come back and say it looks like the grading is not sloping away from the house, and the house maybe needs some downspouts. So in that scenario, the seller says, well, I'm not gonna go hire someone to spread dirt out around my house. I'm just gonna go get a couple yards of dirt and I'm just gonna handle it myself. So we would get a letter from the buyer saying that they are satisfied with the quality of those repairs, whatever they may be, so long as a permit is not required to get those repairs completed. We will approach it from that point of view, that we are gonna ask for evidence from the buyer that says, to whom it may concern, I recognize that Mary and Joe Smith completed the grading and installed new downspouts to my satisfaction. So that's an example of how we would handle that situation. Otherwise, you need to get repairs and you need to get an invoice from a contractor that did the repair. And that's going to be a golden rule regarding any lender that you have on a transaction, because if you logically think about it, you made the expectation that the grading and the downspouts were going to get put in. So we got a paper trail from the buyer saying that they acknowledged that those things were done. Now everyone is covered. Now we're protected that those things were addressed. But if you have a case where someone had to upgrade a service panel, now we maybe want proof that a permit got pulled, we want proof that the service panel got installed, and we want a lien waiver. We have to make sure that we exercise really good judgment getting paper trail for documentation for any invoices, lien waivers, or evidence of a completed repair. That's really super important. What to do at the beginning of a transaction. So this one is kind of vague a little bit, but I'm going to explain what I mean by that. What to do at the beginning of a transaction. You'll send a message, create a cover letter of your own. Send a message to the buyers, and it could be like a templated email too. Send a message to the buyers and the buyer's lender and say, hey, Mary and Joe Smith, congratulations on your accepted offer. It was a surprisingly short journey. We were in competition, and I'm so happy for you that we got this one under contract. Below, please find what to expect going forward. And in there, you will say the following things. And if you have already heard this, I might be overlapping a little bit, but it's really a smart decision to do this. Earnest money needs to be submitted to Shore West or Keller Williams by this date. You'll be writing it to their trust account. Please make sure you drop it off no later than this time, and make sure you send us a copy of the receipt. The home inspection needs to be set up by this date. Here's a couple of good home inspectors that we can recommend for you. Here's when the appraisal needs to be done. Here's when the loan commitment needs to be done. Here's any other things that you need to address. If you're going to get a basement inspection or a radon test or whatever you're going to do, these are all things that you need to bullet point in an email template so that the buyer and the lender can be held accountable. I highly encourage you to start with one email and to always reply to that same email every single time you discuss important details. Because when you're dealing with the high emotions of a real estate transaction, for a buyer or a lender, or for you for that matter, there's this layer of accountability regarding the fact that there's a transcript of your discussion. So here's what's happening now. I got 15 text messages back and forth from someone over here. I got a bunch of verbal discussions around the stuff that I told them to do, and they didn't do it. And then they come back and they try to shoot the messenger. They say, I didn't get that done. I didn't know you wanted it. No, it was right in the chain of the email that we discussed. You'll see it right in there. So if you can always try to use the same email, it's a great best practice just to maintain the chain of communication. Properly listing the address and the buyer's names in an offer to purchase. This is one that comes up often. I go to USPS.com and I verify the property address on USPS.com, not from what the seller thinks the address is or what the listing agent thinks the address is. If you are in a position where you have a property that is considered Lannon, Wisconsin, but the seller put Waukesha, or vice versa, you want to make sure you use USPS.com. If you have a scenario where a buyer is, I'll say, Beth Johnson, but her legal name is Elizabeth M. Johnson, but she goes by Beth. Make sure that it's the legal names for anyone on the application. If the pre-approval letter says one person's name, but it's husband and wife, some lenders will only allow the person who is on the pre-approval letter to be on the offer to purchase. But you wrote both names on there. So with us, you can do husband and wife. But if you're not husband and wife and you're not on the loan, we don't want you on the offer to purchase. So that's why I always make sure I look at that pre-approval letter to make sure that I verify who is listed on the pre-approval letter that is ultimately going to be on the offer to purchase. Okay? And then I already talked about what happens if a seller wants to complete the repair and not use a contractor. I think I just had that in my head earlier and I put it on there last. Just make sure that you provide sufficient documentation that the buyer agreed with the state of the repair. And I'm going to make one more quick add-on bonus item here. You have a buyer and a seller that suddenly are no longer amicable for whatever the reason is. The buyer gets through inspection with the seller and the seller kind of feels like they didn't leave them feeling very good about the state of what they had to do to fix the property. The buyer has a radon test in the offer. The radon test comes out over 4.0. The seller no longer wants to install a radon mitigation system. Do we turn that test result into the lender or not? The test came in over 4.0 for the radon test, 4.0 PCL. Do we turn that radon test into the lender or not? You don't have to. You don't have to turn the radon test in because here's what you can do. And I appreciate the fact that you said that. Basically what happens is if the buyer and this, so we made a radon test contingency in the offer to purchase. If we remove the radon test from the offer to purchase, we no longer care about the results. So if you have a scenario where, let's say, a buyer and a seller had some, and this goes back to negotiating home inspections. So you know that the buyer had a bunch of ticky-tack things that they wanted to address on the property that aren't necessarily going to be considered a defect. What you would do is you would recognize, or with that buyer, that the cost of these repairs is probably worth about $500. And instead of identifying something that the lender could be considering as a safety hazard or a defect of some kind that would be a cause for concern, what you do is say, radon test is hereby waived, seller to credit buyer X amount of dollars at closing. Seller says, forget it, I'm not installing a radon mitigation system. Buyer says, okay, well, I'll split the difference of the cost of the radon mitigation system with you. It's going to cost $1,100 to get one installed. I'll split the difference with you. Seller says, nope, I'm not installing the mitigation system. Buyer says, all right, well, will you pay for half? Yes. I can't say in lieu of installing a radon mitigation system, you're going to give me $500. I can't say that. I have to say this test is waived. Seller to give a credit to buyer for closing costs and prepaid items for X amount of dollars. That will pass underwriting. If you identify a defect that is a detriment to the transaction that the underwriter has to address, you will create problems for yourself. So that's why, and for the client. So you want to make sure that you waive something if it's going to be a detriment to the transaction. Question. We got 2 minutes for questions, probably just right. Are you guys like a sponge that can't hold another drop of water? How did I do? Awesome, I'm glad you liked it. What did you think, Rob?
As always, I learned a lot.
Awesome, I'm glad. That's great. If anyone has any questions, we can chat about any scenario questions that you have, or we can always take them offline too. It's your call.
Thank you, Bill.
You're very welcome. I don't know who was on 130-167-205, but if you have any questions, we're here. All right, guys. Well, if no one has any questions, we're going to sign off for now. We'll be, we're going to pick up a few more classes in the future. I'm going to start doing town hall meetings in September again. I took off of town hall meetings in July and in August because it's pretty busy for everybody. But if anyone wants to jump on a town hall meeting with me in September, we're going to do those on Tuesday afternoons at 4 o'clock. And then that way, if you have any scenario questions, you could bring something to the meeting or whatever. And yeah, we'll work with you to do all that stuff. So thanks for everybody that's online, and we'll talk to you all soon. Have a great rest of your day. Bye, everybody.